Hello everyone. In previous video, I explained you some accounting terms. Today we will understand some more accounting terminologies. So let's start with the revenue concept. Here revenue or receipts refer to the amount received or receivable for selling goods or services. Here received and receivable word are completely different. Here received means amount already received when sales are made on cash basis. But in case of receivable, you have made sales on credit basis, that is, the amount is to be received in future. Now we have to understand selling of what? Here selling means sales made for either goods or services. But what do we mean by goods or what do we mean by services? Here both the terms are different. Here by goods we mean benefits in tangible form, and by services we mean benefits in intangible form that cannot be seen or touched. Receipts are basically divided into two types: capital receipts and revenue receipt. Capital receipt is the amount received or receivable against transactions which are not regular in nature. This receipt is not received regularly. Or we can say that receipts or amount received or receivable after 1 year. For example, sale of plant and machinery. Say you have purchased plant and machinery in year 2012. You used it and after that you sold it in year 2015. So this machine benefited you for more than 1 year, and after that you received some amount on selling such plant and machinery. So we call such sale of used plant and machinery as our capital receipt. Apart from this, not only sale of plant and machinery, but other assets such as building, furniture, as assets are not sold regularly. Then receipt of loan amount. Say you have taken a loan and it's obvious that this receipt is not just for 1 year. But if you have taken long-term loan, then the payment of loan will be after few years. Until then, the amount is called as capital receipt. Then investment made in your business, etc. are examples of capital receipt. The next category is revenue receipt. Revenue receipt is the amount received or receivable in the normal course of business, such as sale of goods and services made, and payment will be received within 1 year. Then interest received, then income of commission, etc. This kind of receipt arise frequently. Revenue receipts is also known as revenue income. Now next term is expenditure. Expenditure refers to a payment or spending or a promise to make future payment for benefits received, that is for assets or services. Expenditure may be categorized into two categories: capital expenditure and revenue expenditure. So let us understand what is capital expenditure. Capital expenditure is an expenditure incurred to acquire assets or improving the existing assets which will increase the earning capacity of the business. This payment is not regular in nature. It arises when fixed assets are purchased, and we know assets are not purchased frequently. For example, purchase of machinery to manufacture goods, purchase of furniture, building, etc. Now let us see what is revenue expenditure. Revenue expenditure is the expenditure incurred, the benefit of which is consumed within the accounting period, that is 12 months. Generally, the accounting period consists of 12 months. The flow of these payments would remain constant. From these payments, profit and loss is determined. Example of revenue expenditure are salaries, rent, electricity expense, cost of goods sold, taxes, insurance, etc. It will also include expenses incurred for maintenance of various assets by way of repairs, renewals, and replacement of building, plant and machinery, vehicles, etc. Now the next term is deferred revenue expenditure. These expenses are known as fictitious assets. Deferred revenue expenditure is a revenue expenditure in nature, but is written off or charged in more than one accounting period. Or we can say that it is a large sum of revenue expenditure incurred in some cases. The benefit of such expenditure may extend to a number of years. Hence, this expenditure is not charged straightly to profit and loss account, but a portion of it is charged every year to profit and loss account for the prescribed number of years. The amount which remains unchanged at the end of any particular year is deferred revenue expenditure, which is put as an asset in the balance sheet. For example, large advertising expenditure that will give benefit for more than one accounting period is a deferred revenue expenditure. Now next term is expense. Expense is the cost incurred for generating revenue. It is the amount spent and benefit of which is available to the respective accounting year is revenue expense. Or we can say that an expense is the amount spent in order to produce and sell the goods and services which produce the revenue. Examples of expenses are payment of salaries, wages, rent, brokerage, commission, discount, etc. Now coming to the next term, that is profit. After deduction of regular payments, which we call revenue payment from regular receipts, which is known as revenue receipts of the year, the remaining surplus is known as profit. Or in more simple terms, we can say that the excess of day-to-day incomes over expenses of the business is called profit. But this will be called revenue profit because this profit is the difference of revenue incomes and revenue expenses. This is regular profit. But many times there is a creation of irregular profit, or we can say that a profit that arises from transactions which are incidental to business is known as capital profit. For example, profit on sale of fixed assets. Profit is normally categorized into gross profit and net profit. Gross profit is the difference between revenue from sales and or services rendered over its direct cost. And second is net profit. Net profit is the profit earned after allowing for all expenses. Now the next term is loss. Loss is excess of expenses of a period over its related revenues, which may arise from normal business activities. The computation of loss is contrary to profit computation. In more simple terms, we can say that the difference obtained by the deduction of regular incomes from the regular expenses is called loss. This is called revenue loss. Sometimes there can be happening of loss without doing any kind of activity. This is also recorded in the books of accounts. For example, goods destroyed by fire, goods stolen, goods destroyed due to rain. Loss also arises from events of non-recurring nature, which is called capital loss. For example, loss on sale of fixed assets. Loss can also be categorized into two categories, gross loss and net loss. When the sales revenue is lesser than the cost of goods sold, the difference is called as gross loss. And when the sum of revenue is lower than the sum of cost of goods sold and other administrative, selling and distribution expenses, it is called as net loss. Now next term is purchase. Goods bought for resale are called purchases. This may be in the form of raw material or finished goods. Purchase of assets is not called purchase because assets are not purchased for resale. The term purchases includes both cash and credit purchase of goods. Goods purchased for cash are termed as cash purchase and goods purchased on credit are termed as credit purchases. Now our next term is sales. When purchased goods are sold in order to earn a profit are called sales. Sales can be of two types, cash sales and credit sales. If the sale is for immediate cash payment, it is cash sales. And if payment for sales is postponed, it is credit sales. Now the next term is stock. Stock is a tangible asset held by an enterprise for the purpose of sale in the ordinary course of business or for the purpose of using it in the production of goods meant for sale. Stock may be opening stock or closing stock. Opening stock is the stock in hand in the beginning of the accounting year. And closing stock is the stock in hand at the end of accounting period. Stock may be of the following kinds. First is stock of goods. Stock of goods in the case of a trading concern comprises stock of goods remaining unsold. In the case of manufacturing concern, it comprises processed goods manufactured for the purpose of sale. The next is stock of raw material. It comprises the stock of raw material used for manufacturing of goods lying unused. For example, stock of cloth to be used for stitching shirts. The next is work in progress. It is a stock that is in the process of being finished. That is, they are partly finished goods. So that's all for today. Thank you very much.